Welcome back to Investing Talk Podcast.
Today we're looking at Indonesia energy.
As usual, before we start, subscribe, like, and comment to this video to support the show.
So, yeah, we have a really fascinating paradox in the market to unpack today.
We really do. I mean, you look around and global oil supply chains are just incredibly tense right now.
Right.
There are these massive macroeconomic shifts happening daily. But instead of focusing on the massive multinational conglomerates that usually dominate the financial headlines.
The heavyweights.
Exactly, the heavyweights.
Yeah.
Instead of those, the data is pointing us toward a tiny microcap company. And this company is just outperforming the giants in pure, unadulterated volatility.
It is a perfect case study of how global anxiety can manifest in the most unexpected corners of the stock market.
Yeah.
We are seeing a stock that acts less like a traditional energy investment and more like a real-time barometer for geopolitical tension.
So our mission for this conversation is to figure out exactly why this tiny energy explorer is suddenly experiencing such explosive price action.
Right. We need to separate the fundamental reality of the actual business from the swirling geopolitical hype.
Exactly. And by the end of this conversation, the goal is to help you understand whether Indonesia energy represents a solid long-term fundamental play, or if it is strictly a highly volatile swing trade driven by headlines.
And to do that, we have to look at this through a purely analytical, completely impartial lens. The background data heavily cites ongoing geopolitical conflicts, specifically the U.S., Israel, and Iran escalations, as the primary catalyst for this stock's movement.
Yeah.
We are going to examine how those specific global events threaten to impact oil supply chains, and consequently how those supply chain fears artificially inflate or deflate the stock price.
We were looking strictly at the math, the geography, and the market mechanics. So, to kick things off, let's move into the fundamentals.
Let's do it.
Let's start with the foundation here, which is the sheer scale of this business, or more accurately, the lack of scale.
Yeah, calling Indonesia Energy a microcap company almost feels like an understatement.
It really does. Their recent revenue sits between $2.66 million and $2.667 million.
Which is tiny.
It's nothing. In the global energy sector, where companies routinely measure their quarterly revenue in the hundreds of billions, this company is an absolute minnow in the ocean.
But that tiny scale is actually the most critical factor in their current market position. It dictates everything about how the stock behaves.
How so?
Well, their primary asset is the Cru block in Indonesia. That is their operational stronghold, and it provides them with vital geographic exposure to Southeast Asian energy demand.
Right.
That single asset, combined with their microscopic size, functions as their competitive moat.
Wait, I have to stop you there.
Okay.
Usually when you talk about a moat in the energy sector, scale is literally everything. If you don't have billions of dollars to build infrastructure, to lay pipelines, to weather years of bad drilling results, you get crushed by the competition.
Yeah, usually.
So how can generating barely $2.6 million a year be considered a competitive advantage?
I know, it seems completely counterintuitive until you look at how commodity cycles operate during a crisis.
Okay, walk me through it.
Think of the massive oil conglomerates as giant cargo ships. They are incredibly stable, and they produce massive amounts of cash, but it takes them miles to turn around or change direction.
Right, they're slow.
Exactly. When global oil prices spike suddenly, a mega-cap company won't see a massive proportional jump in its overall stock price immediately.
Because they're insulated.
Right. Their operations are too vast, their future oil sales are heavily hedged at lower prices, and their overhead is astronomical.
So the needle doesn't move much for the giants.
Precisely. Indonesia Energy, on the other hand, is a speedboat.
A speedboat?
Yeah. They are entirely unhedged and highly concentrated at the Cru block. When there is a sudden, sharp rally in the underlying price of crude oil, a nimble upstream explorer captures that momentum instantly.
Oh, I see.
Every single dollar increase in the price of a barrel of oil flows directly and visibly into their potential future margins. They offer pure leveraged exposure to crude prices without the sluggishness of a massive corporate bureaucracy.
Okay, a nimble speedboat sounds great in theory, but only if it doesn't have holes in the hull.
Fair point.
Let's look at the financial health check, because the balance sheet here is actually surprisingly clean for a microcap explorer.
It really is.
Usually, these tiny exploration companies are drowning in toxic debt just to keep the lights on and fund their drilling operations.
Oh, yeah, constantly diluting shareholders.
Exactly. But this company is sitting on $4.57 million in cash and cash equivalents. Their total assets are at $21.91 million. And they carry only $3.7 million in long-term liabilities.
Which means they have a leverage ratio of about 1.2.
Right.
In plain English, for you listening, for every dollar of long-term debt they owe, they have more than enough equity to cover it.
Yeah.
In the oil business, where companies usually borrow heavily to fund massive, expensive drilling rigs, having a ratio this low means they aren't going to go bankrupt just because of a couple of bad months or a temporary dip in oil prices.
But let's be realistic about that $4.57 million in cash.
Okay.
In the world of oil exploration, $4.5 million isn't going to fund a massive multi-year drilling campaign across new territories.
No, absolutely not.
It's enough to keep the operations at the crew block moving forward, but it's not exactly a war chest.
Which explains their capital allocation strategy. They aren't paying dividends. They aren't buying back stock to artificially boost the share price.
Every available dollar is going back into the ground.
Exactly. Reinvested right back into the crew block. At this stage in their life cycle, survival and incremental growth are the only priorities. They are trying to optimize operational efficiency, not reward shareholders with short-term cash payouts.
Okay, so that clean balance sheet and focused operation is a solid baseline.
Yeah.
But it absolutely does not explain the fireworks we have seen on the charts recently. Yeah. So let's pivot to the technicals and what is actually triggering these moves.
The recent price action has been violent.
Very. On March 6, 2026, shares jumped 12.38% to 12.42% in a single session.
Massive move.
We are looking at a highly volatile trading range where the stock swings wildly between $5.64 and $8.69.
And that level of volatility doesn't come from a minor operational update at the crew block.
No.
The trigger for that explosive movement is entirely macroeconomic. It goes back to the U.S., Israel, and Iran escalations we mentioned earlier.
Right.
When those tensions flare up, the immediate fear in the global markets is that the Strait of Hormuz could be closed, restricted, or deemed too dangerous for commercial shipping.
And for context, the Strait of Hormuz is arguably the world's most critical oil choke point.
Without a doubt.
It's a narrow waterway between the Persian Gulf and the Gulf of Oman. Roughly 20 to 30% of the world's total oil consumption passes through that strait.
It's a massive bottleneck.
If a geopolitical conflict restricts flow there, the global supply of oil shrinks dramatically overnight, while global demand remains exactly the same.
And when supply shrinks and demand is inelastic, prices skyrocket.
Basic economics.
Right. When the market prices and the mere possibility of a supply shock of that magnitude, crude oil prices naturally spike. For an upstream exploration model like this acts as an immediate, massive tailwind.
Because they're the speedboat.
Exactly. The market recognizes that Indonesia Energy is a pure play on oil prices. The stock reacts violently to the geopolitical headlines because traders are using it as a proxy for the conflict itself.
Let's dig into the technicals to see how that plays out on the charts, because there are very specific levels that traders are battling over.
There is strong psychological support holding between $5.20 and $5.50.
Right. Every time the stock dips into that territory, buyers step in to prop it up.
But on the flip side, there is heavy resistance between $5.80 and $6.70. Whenever it pushes up into that range, the selling pressure intensifies.
And what is pushing the stock through those resistance levels is momentum flow, specifically fueled by above-average trading volume.
This is a crucial metric. When a stock jumps on low volume, it is usually just a few isolated trades in an illiquid market.
Doesn't mean much.
Right. But this stock is experiencing sustained, heavy volume. It indicates that speculative buying pressure is currently outweighing the natural downward trend of people taking profits.
So the momentum is real.
The momentum is real, yes.
Well, let's move over to sentiment and figure out who is actually driving that volume, because the daily news flow is giving investors absolute whiplash.
Oh, complete whiplash.
The quantitative sentiment scoring is heavily bullish right now. But one day, the headline screams that the stock soars on a muddy supply shock following a military strike. And literally 2 days prior, the headline was about the stock pulling back Tuesday as traders retreated.
When you look at the flow of money, there is a glaring detail that explains that whiplash.
What's that?
There is zero recent institutional cluster buying.
Wow.
Zero. There are no Form 4s or 13Fs being filed.
Meaning no large hedge funds, no mutual funds, no corporate insiders are quietly loading up on millions of shares to hold for the next 5 years.
Correct. Institutional investors act as anchors for a stock's price. Because they buy massive blocks of shares and hold them, they reduce volatility.
They stabilize things.
Right. But Indonesia Energy does not have that anchor. Furthermore, it has a very low float.
And the float is the number of shares actually available for the public to trade.
Think of it like a small theater with a very limited number of tickets. When a geopolitical headline hits and thousands of people suddenly want a ticket, the price goes astronomical because no new tickets are being printed.
So without the institution stepping in to absorb some of that demand, this incredible momentum is almost entirely retail-driven.
It is entirely individual traders, day traders, and retail syndicates. What we are seeing is classic FOMO fear of missing out colliding with a very real geopolitical threat.
Yeah.
When retail traders see a microcap acting as a proxy for Middle East tensions, the actual fundamentals of the company cease to matter for that specific trading day.
The stock simply becomes a vehicle for momentum.
Exactly.
And whenever you have a low-float stock driven purely by retail momentum, the rumor mill goes into overdrive.
Oh, absolutely.
When you look at the chatter surrounding this stock, there are some wild speculative catalysts floating around.
There are rumors of meme stock dynamics taking hold where social media communities try to force a short squeeze.
I've seen those.
There are also whispers that if their crude block expansions are successful and if global oil prices stay elevated for a prolonged period, they could become a prime target for mergers and acquisitions.
But we have to heavily discount that M&A speculation, right?
We do. These rumors are unconfirmed and highly speculative. They're operating entirely without any official corporate filings or structural data to back them up.
But in a retail-dominated, low-float environment, the rumor itself is often enough to fuel the fire.
Right. And looking forward, we don't have the 2025 10K or 10Q data available yet to see how the recent operations have actually impacted their bottom line.
We do have forward-looking price targets from analysts, though, and they are completely all over the map.
Which perfectly reflects the underlying volatility. Conservative estimates place the price target around $5.59 to $6.16.
That essentially assumes the status quo.
But there are highly aggressive upward revisions pointing all the way to $15 a share.
To hit $15 a share, what actually has to happen on the ground at the crew block?
The analysts modeling that $15 target are hoping to see the company scale its top-line revenue up to an estimated $4.46 million.
Okay, from the roughly $2.6 million they have now.
Right. If they can execute on their drilling programs and hit that 4.46 million mark, it would provide a much stronger fundamental floor.
It would prove that they can actually capitalize on these high oil prices and scale the business, rather than just riding the geopolitical premium.
Right. Okay, let's transition to the risk section here.
Okay.
We've talked about the cash, the nimble operations, the massive price jumps, the retail flow, but we really have to pump the brakes and play the skeptic, because the bear case is loud.
It is very loud.
The risks embedded in this stock are absolutely glaring, and the most alarming metric by far is the valuation. The price-to-sales ratio is sitting somewhere between 25.4 and 28.37.
That multiple is the single biggest red flag for anyone looking at this as a long-term investment.
It's massive.
To put a price-to-sales ratio of 28 into perspective, in the traditional energy sector, a PS ratio of 1 or 2 is the standard.
Wow.
Often, massive oil companies trade at a PS of less than 1. Paying 28 times sales for an energy exploration company is an astronomical, almost unthinkable multiple. You usually only see a multiple like that in hyper-growth tech startups.
Right.
Software companies that have zero marginal cost to duplicate their product. But pulling oil out of the ground is incredibly expensive. Every new barrel costs money to extract.
Yes.
So why is the market assigning a software multiple to an oil driller?
Because the market is pricing in absolute perfection. Despite the clean balance sheet we talked about, the fundamental reality is that the company suffers from low profit margins.
Because the cost of exploration is immensely high.
Exactly. While they have $4.5 million in cash, their overall resources are fundamentally limited compared to the capital required to massively scale up operations.
So when investors pay 28 times sales, they're betting on what?
They're betting on a flawless expansion of the crude block, sustained high oil prices for years, and zero operational hiccups.
But if a drill bit breaks or well comes up dry, A valuation that inflated collapses instantly.
Instantly, the margin for error is essentially zero.
Which brings up the ultimate double-edged sword, the geopolitical environment.
Yes.
We established that the U.S., Israel, and Iran conflict is creating a massive tailwind, pushing the stock price up as traders fear a supply shock in the Strait of Hormuz.
Right.
But what happens if the macro environment suddenly changes? What happens if diplomats step in, a ceasefire is reached, tensions cool down, and the threat to global shipping evaporates?
The oil shock premium vanishes in a matter of hours. The historical data explicitly shows that geopolitical pullbacks lead to immediate, aggressive retreats in the stock price. We've already seen how fast those de-escalations can trim gains.
Because the underlying revenue just doesn't support the price.
Exactly. Because the stock's current price of around $6 or $7 is so heavily disconnected from its fundamental revenue of $2.6 million, the moment the geopolitical fear leaves the market, the speculative retail money leaves with it.
And as we said, the stock has no institutional anchor to stop the slide.
None at all.
So, bringing all of this together, we have the crew block expansion, the surprisingly clean balance sheet, the massive geopolitical tailwinds, the retail FOMO, and the glaring, almost absurd valuation risks.
Quite the mix.
It really is. The overarching conclusion from the analytical data assigns Indonesia Energy a 7 out of 10 bullish score.
But there is a massive flashing warning sign attached to that 7 out of 10 score.
It is entirely contextual. For you listening, this is the most important takeaway. That bullish score is explicitly, clearly labeled as a 1 to 3 month swing trade.
Yes.
It is designed specifically to capitalize on the current macro volatility and the upcoming catalyst events in the near term.
It is absolutely not a safe buy and hold forever stock.
No.
This is a momentum play driven by global headlines and retail sentiment, not a Warren Buffett value investment.
That distinction changes how you approach the stock entirely.
It changes everything. If you are holding this, you are holding it because you believe the Middle East tensions will escalate in the next 90 days, not because you believe in the 10-year operational cash flow of the crew block.
Right.
And I think that leaves us with a really important lingering question to ponder long after this show is over.
What's that?
When a micro-cap company's valuation becomes so heavily disconnected from its actual day-to-day revenue and instead becomes a mirror for global geopolitical anxiety, are investors really buying a piece of a business or simply placing a casino bet on global instability?
That is a phenomenal question. It's a blurry line, and with a stock like this, that line is shifting every single day.
It really is.
That is exactly the kind of question you need to be asking yourself when you see these massive, inexplicable price swings in the headlines. Thank you for joining us today. Keep looking past the hype, keep digging into the balance sheets, and always remember to question the mechanics behind the momentum.
Don't forget to subscribe, like, and comment to support the channel.
We'll catch you next time.